We're going to get more and more inflationary data this week with the consumer inflation numbers coming in tomorrow, producer inflation numbers coming in on Thursday. That'll kind of set the tone for the week because that's major numbers coming in right now. But I do want to show you a little caption right through here. We did have one Fed official talking today. I did look her up to see, is she a dove? Is she a hawk? What's her thoughts? So I'm going to play a little clip up here. I won't play the whole thing. Just the thoughts on the one Fed official that came out today and actually spoke. What's she have to say?
Steve Leisman has the very latest. Hi, Steve.
Hey, Kelly, thanks. Yeah, futures markets quickly priced out a summer Fed rate cut after the U.S. deal with China for a 90-day pause from the most extreme tariffs. Markets pushed ahead the first cut to the fall, now see just 2 cuts this year. Meanwhile, comments from a Fed governor suggest the economy, at least in her opinion, is not completely out of the tariff woods just yet. So the probability of the first cut coming in July has fallen to 42% from 69% on Friday. September now priced with an 82% probability of that first cut. A second cut now in October, just barely priced in, maybe a little bit towards the 60% weight, with more confidence in December. And the third cut in December is now priced out. Markets.
This is just between, what I want you guys to understand is if you read the data over there, this is where the orange is where we were Friday, before the China thing, and then it diverted to this. So in October, chances of a rate cut, they're 71%. Now they're under 58%. So you can see all the way over there in July, there was about a 70% chance of a rate cut. Now it's under 50%. So there's a lot of good news, and I thought a lot of this would transpire over into lower rates, but that's actually the data that we're seeing right now. I'll let Steve continue with some of this information. It's pretty informative.
Bet that the Fed would meet the stagflation threat by ignoring inflation and addressing the weaker growth side. The Fed last week threw some cold water on that, saying risks to both higher inflation and unemployment had increased. Well, the risks to both would now seem to be lower, though they have not yet disappeared. Adriana Kugler, Fed governor, said at an event this morning that even at current tariff levels, the economic effects will remain significant from the tariffs. There could be some permanent tariff inflation effects that she's concerned about, but hard to judge the pace of U.S. economic growth because of the impact of front-running of tariffs and the decline in expectations. Policy, she says right now, however, is well-positioned to deal with either eventuality. Despite the agreement, some tariff-related price increases will still hit the economy. 30% tariffs on China, still pretty high, and uncertainty now extends 90 days out. But clearly, recession odds have declined.